Hello, everyone, and welcome to Thursday Talks with Chug. Each week, we cover pressing topics that matter to you and your business. I'm Arianna Gonzalez from Chug, attorneys and CPAs tuning in from our San Diego office. Please join me in welcoming CPA and senior tax accountant Hansa Patel from our headquarters in Los Angeles. Hi there, Hansa, and welcome.
Thank you, Arianna, for your introduction. Thank you very much, everybody, for taking time to go over with this presentation.
Thank you so much for being here. For today's topic, we will be covering your most pressing questions on tax deductions checklists for small businesses. Just a quick disclaimer before we get started, this conversation is for informational purposes only. It does not create an accountant-client relationship. So if you have questions, please email us at info@chug.com so we can help you out. Now let's get right into it, Hansa. Can you tell me what are tax deductions and how do they benefit small businesses?
So let me start first with what is the small business. So
Perfect.
IRS defines the small businesses are those who files the Schedule C, like a self-employed, partnership, LLC, S corporation, or C corporation. They generally consider less than 50 employees and the revenue ranges around 20 million, but it depends upon the industry to industry as a small business. So what are these tax deduction and how they benefit the business? So business tax deduction are generally the expenses that can subtract from the business income to reduce the amount of income subject to the tax. This deduction lower their tax liabilities. Some of the deduction example are cost of goods sold, raw material purchase, services, operating expenses such as rent, utilities, salaries, and other day-to-day expenses. When I'm talking about the business income, it means the gross business income. Like say example today, the customer is coming to you and he's paying you $100. That $100 becomes your business gross income. And from that gross income, we're gonna talk about this business deduction, which we can deduct about it. So that's what the tax deduction, and that's how they benefit the small businesses.
What about the difference between a tax deduction and a tax credit? Can you explain that to us?
So tax deduction and the tax credit, they both reduce the tax liabilities, but in a different ways. The tax deduction reduce the business taxable income, which in turn lowers the amount of income that is subject to the tax, while tax credit reduce the amount of tax business owe for dollar-to-dollar basis. For example, today, my business income is $20,000. My tax deduction, like a rent, utilities, etc., is $10,000. Then my business taxable income is now $10,000. Tax deduction helps to reduce the income which is subject to income tax. While tax credit, say example, my taxable income is 10,000 as we discussed above, and business owe now 1,000 in the taxes. If I have tax credit of $500, then my tax liability now became $500 only. So I owe IRS only $500. Tax credit reduced the taxes business owe on dollar-to-dollar basis. And in this example, it reduced from $1,000 to $500. So that's the biggest difference between the tax deduction and the tax credit.
Oh, wow. Very interesting and very important for our audience to know the difference between those two. So can you touch on what are the general eligibility criteria for claiming tax deductions as a small business? What do we need to know about this?
So IRS generally requires that business expenses has to be both necessary and the ordinary. It means it should be accepted in your industry as a business expenses and helpful to run your business. For example, office supplies for the doctor office, clothing materials for the clothing raw materials for the clothing manufacturers. These expenses are necessary and ordinary to run the business. Another criteria, timing of the expenses. Expenses must be incurred during the tax year for which you are filing a tax return. Example, office rent paid in December 2023 can be deducted on your 2023 tax return if you are on a cash basis taxpayer. I cannot go ahead and deduct this December 2023 rent I paid in 2023 as a 2024 December expenses. So the two is important condition are both has to be first ordinary and necessary to run the business. And second criteria is it has to be timing of the expenses. So those are the generally the requirement and criteria for to claim as a business deduction.
Wow, really good to know. So can you explain the difference between deductible and non-deductible expenses?
So the difference between the deductible and non-deductible expenses is mainly about whether or not you can deduct them from your business taxable income as a business tax deduction. Common business deduction are those are necessary and ordinary to operate the business like rent, utilities, supplies, etc. While personal expenses are non-deductible. Say example, meals expenses while meeting a client that can qualify as a business expenses, while meals with the family and friends, those are not a tax deductible. Those are the non-deductible expenses. So non-deductible expenses do not change your taxable income, which is subject to the tax, cannot be used to claim as a business deduction. So that is the main criteria when you are claiming the expenses. You need to see whether it is deductible or non-deductible expenses based on the business or in the industry.
Wow, that's such great information. So regarding some tax deductions that small businesses often overlook, do we have an example of some common tax deductions that small businesses should know about that maybe sometimes are often overlooked?
Yeah, definitely. You know, the most of the time I have seen in my practice area, when the business starts, like when the person start the business, there are the higher chances of overlooking those expenses. Some of the expenses are startup costs, like organization cost of the business. If I'm operating the LLC, if I'm going to start the LLC, those LLC expenses when I'm setting up with the California, say example, those expenses sometimes overlooked because I paid out of my own personal pocket. Charitable contribution, home office deduction, the bad debts, only if you reported income on the accrual basis, health insurance, education and training, website development, email marketing, printing business card, other materials at the initial phase of your starting of the business, travels, meals related to the meeting new clients to develop the business. Most of the expenses are overlooked at the beginning phase of the business. And these are the some of the expenses which you can deduct as a business deduction, even though you have paid out of your personal pocket.
Oh, wow, that's very interesting. So you did mention home offices. So can you touch on how can small businesses deduct home office expenses? What do they need to do for this?
So IRS has a two basic requirement to claim as a home office deduction. The first condition is they are generally must be exclusive use portion of the home for conducting the business on the regular basis. For example, taxpayer who uses an extra room to run their business can take the home office deduction only for that extra room as long as it used both regularly and exclusively in the business. That means working from your bedroom does not count as a home office deduction. Second, the home must generally be the taxpayer principal place of the business. A taxpayer can also meet this requirement if administrative or management activities are conducted at home and there is no other office location to perform these duties. It must be regular or normal place where you work and you conduct most of all important businesses from this location. For example, if you are a medical provider who sees the patients in the hospital, but you do your paperwork and billing at home, that likely would not qualify as a home office deduction as it does not consider your principal place of the business. Taxpayer who qualify for the home office deduction may choose one of the two methods to calculate their office business deduction. The first method is simplified option has a rate of $5 per square foot for business use of home. The maximum size of this option is 300 square feet, and maximum deduction under this method is $1,500. I generally advise my client to use the simplified option method because that is easier to prove to the IRS that we are using this home office deduction exclusively for the business. Second method is the regular method. Deduction for home offices are based on the percentage of the home devoted to the business use. The taxpayer who use the whole room or part of the room for conducting their business need to figure out the percentage of the home used for the business activities. They may deduct the expenses such as the mortgage interest, insurance, utilities, repairs, maintenance, depreciation, rent, etc. Only portion of it which they exclusively use for the percentage for the business activities. I just want to mention one more thing. Employees working from home, they cannot claim the home office deduction because that is not their principal place of the work. Just wanted to mention that one thing.
Wow, thank you for all of that information. So are there specific deductions available for businesses with employees, such as wages and benefits?
Yes, so there are some specific deduction available for the businesses with the employees, and some of the expenses are employee salary and the wages and related to the payroll taxes expenses. IRS do allow to deduct full cost of the salaries and wages paid to the employees. Compensation include regular pay, overtime, bonus, and any other form of the compensation you can claim as a deduction. Social Security and Medicare taxes paid to the IRS as an employer portion are also tax deductible. Just want to mention that, the 7.65% which employees pays the Social Security and Medicare taxes, businesses are required to match that percentage on the salary and wages that they can claim as a deduction. The second thing is health insurance and the retirement contribution. Any insurance premium paid by the businesses on behalf of the employees are business deductions, such as for dental, medical, and vision insurance are the tax deductible. Retirement contribution made by the business for the retirement plan for such as like 401k, where employer is matching the contribution of certain percentage. Profit sharing plan, those are the business tax deductible for the business. Only the portion which employer is incurring for the on behalf of the employees. They cannot deduct which employees paying from out of their pay. Life insurance and disability insurance, workers' compensation insurance, those premium paid by the business are tax deductible. Training and education. The cost for the employees' training and the professional development courses directly related to the business are tax deductible if incurred by the business. Meals. Business can deduct up to like 50% cost of the meals provided to the employees. So these are the some of the expenses which business can deduct related to the employees.
Wow, those were all really great examples. I do want to get into record keeping a little bit. Do we have information on what kind of documentation is required to support tax deduction claims?
Yeah, so business needs to retain, like say example, vendor invoices for the purchases, the bills, proof of the payment has been made. Sometimes credit card statement IRS would require. Sometimes they request the copy of the canceled checks that they want to verify that payment has been made, and the bank statement to support the deduction. These records only required if IRS audits you. You don't require these records while you are filing a tax return. You don't need to submit that, but you need to keep those records just handy in case if IRS comes to audit your business.
So how long should small businesses retain these records related to tax deductions? Is there a general suggested length of time?
Yes, there are, but IRS requires the length of the time you should keep the document depends upon the action, expenses, or the event. Generally, you must keep your records that supports the item of the income, deduction, credits shown on your tax return until the period of limitation for the tax return runs out. IRS requires to keep the record for minimum 3 years. from the date you file your original tax return. But there are some different requirements. If keep the record for 7 years, if you have claim for the loss from the worthless securities or the bad debt deduction. Keep the records indefinitely. If you don't even file a tax return, then they require to have the record indefinitely. Keep the record indefinitely if you file the fraudulent return. And employment tax records, say example 941, W2, 940, which is related to the payroll expenses, those IRS required to keep at least for 4 years. So minimum requirement is generally 3 years with some exceptions.
Wow, all really great things to keep in mind. If you are watching this and have additional questions about this, reach out to us. We'd be happy to connect you with Hansa who can help you further. So let's talk about deduction strategies. Can small businesses benefit from depreciation and amortization deductions?
Definitely, small businesses can significantly benefit from the depreciation and amortization deduction. This deduction allows the business to spread the cost of certain capital expenditure over the useful of their life, which can reduce the taxable income each year. Business can deduct a portion of the asset cost each year, reflecting the asset usage, wear and tear. Some of the capital expenditure are the purchase cost of the building, improvement, equipment, vehicle, etc. For example, business purchased the furniture worth rupees $5,000. It has a useful life of 5 years. IRS requires that you cannot deduct the expense of buying furniture in the year you have purchased for $5,000, but you need to spread it over useful life of the furniture. So in this case, business can deduct $1,000 every year as a depreciation expenses, assuming the useful life of the furniture is for 5 years. Amortization expenses. Amortization expenses, only the key difference between the amortization and depreciation is amortization expenses claim on the intangible assets over the useful life of asset. Basically, it is non-physical assets like patent, copyrights, trademark, goodwill are generally etc. are amortization assets like capital expenditure. Generally, IRS allows to amortize over the 15 years of period. So goodwill, patent, everything you can amortize over the 15 years of the life.
Really great information. So what about Section 179? What are Section 179 deductions, and how can small businesses take advantage of these deductions?
So Section 179 deduction is a provision in the US tax code that allows the business to immediately deduct the full cost of the qualified capital asset in the year they are placed in the service rather than depreciating the cost over the several years. This can result in significant tax saving and improve the cash flow for the business. Like we discussed about $5,000 the furniture expense, that if they qualify, they can claim whole $5,000 in the year they have incurred that cost.
Wow.
Some of the key features of this 179 deduction is it allows immediate expenses. So allows the business to deduct the entire purchase price of the qualifying assets in the year they are acquired and put into the service. For example, business purchase a new machinery for the 50,000 in 2023. Under Section 179, business can deduct the entire 50,000 in 2023 tax year and reduce its taxable income by that amount. It is very good tax planning strategy for the year end where you want to plan out your taxable income. So what are the qualifying assets which qualify for this 179 expense? It includes the tangible properties such as machinery, equipment, computer, furniture, certain vehicles. Improvement to the existing buildings like roofing, HVAC system, security system can qualify. Certain software and business related property may qualify for the 179 expenses. What are the deduction limit? There are some deduction limit for the qualifying assets. So Section 179 deduction limit for 2024 was raised to 1.220 million with the capital purchase limit of around 3 million. Other thing I want to mention about the bonus depreciation. Generally, taken after the 179 spending cap is reached, which we discuss around the 1.2 million. Bonus depreciation allowed the business to take the additional first-year deduction on new and used qualified property under the Section 168K. For 2024, it allows to depreciate 60% of the capital asset in the first year. So say example, you might have bought like almost 2 million capital expenditure for your business. You can qualify for 179 deduction limit up to 1.2 million. For the rest of the asset, if you don't want to like useful life of the 5 years, you can go ahead and claim the 60% cost of the depreciation in the same year. So you are only making sure that useful life of the asset you're going to spread it over the year is only the 40% of the cost. So what are the some eligibility to claim these expenses? To qualify, the property must be used for bonus depreciation more than 50% for the business. The property must be purchased and placed in the service within the same tax year for which you are claiming the deduction. So it is a requirement that it has to be placed in the service in the same year when you are claiming the deduction. There are some of the restriction on the 179 deduction. The Section 179 deduction cannot be used to deduct the cost related to the investment in the rental property, like which is your passive investment, or the property used primarily for the personal purposes. Like say example, I purchased the vehicle for my personal use, that cannot be qualified as a 179 deduction. The deduction cannot exceed the taxable income of the business. Any excess can be carried forward to the future years. So say example, my taxable income is 50,000. My capital expenditure may be 60,000. I can only claim the 179 deduction up to the taxable income, which is 50,000. The 10,000 I have to carry forward to the next year. So 179 deduction cannot generate the loss for the business. That is the one of the requirement. The deduction cannot exceed the taxable income, and any excess can be carried forward to the future use. So those
Wow,
are the 179 deduction.
Such great information. Thank you so much, Hansa. I know you do have a busy day, so we are short on time, but I do want to ask you one more thing. When should a small business seek professional help from a CPA for managing their tax deductions?
I would suggest that small business should consider seeking a professional help from the CPA in several situations, like multiple income streams are there, complex tax deduction where they are not sure whether how they should pursue with this deduction, business expansion, major purchase to identify whether they can qualify for 179 deduction or the bonus depreciation, tax planning strategy, entity structure, and filing requirement for the tax returns. They should discuss with the CPA. So that's from my side. Thank you everyone for listening to me and taking a time to listen to this presentation.
Such great advice. Thank you so much, Hansa. And there is support for small businesses if you are running one. So please reach out. We'd love to let you know all of the deductions available for your small business and how we can set you up for success. So that is all we have time for today. Thank you so much, everyone, for joining us today. Again, a special thank you to you, Hansa, for taking the time. To stay up to date, please subscribe and follow us on Facebook, LinkedIn, and YouTube. If you have questions or suggestions, email us at info@chug.com. Let us know what topic you want to see next. And make sure to join us back here next week for more pressing topics that truly matter to you and your business. Until next time, stay safe and take care, everyone. Thank you for joining us. Thank you, Hansa.